Dave Ramsey says you should save to pay cash for a house. But here's the problem. That's like a Dalmatian trying to chase a fire truck. You keep running after it, but the faster you save, the more the house price goes up and runs away from you. So in this episode, I'm going to show you how locking in a mortgage could actually be the smarter move rather than just saving your way, which could cost you the very home that you want. Tune in. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you if you want your money working harder for you, so you have to work so freaking hard for that money. And if you want to become work optional, where you work because you want to, not because you have to. You're not all about retirement. You're about living a life of purpose. You're about doing what you love with those you love. But more importantly, you're here to live a rich life, because as you're blessed financially, as you prosper and grow more, you can now create greater abundance and prosperity and create a ripple effect through the lives of others. And that's what it means to be a Rippler. Thank you for tuning in, for binging and sharing these episodes, because without you, we have not been going on nearly 1,000 episodes strong. That's all because of you guys. Hey, if you want to create a ripple effect that would benefit us so much so we can create more value for you, please like this episode, share this with others, share it on social media, whatever it might be, even if it's your favorite episode, even if it's not this one. Share an episode, because please, we can help more people. In fact, we have a goal to help 1,000 families become financially independent by the year 2030, which could be you. So again, if you have questions, always reach out to us at moneyripples.com. All right, so let's talk about saving cash for a house, right? I talk about this as almost like the Dalmatian chasing the fire truck. And this came up because I made a post on my Facebook page. And of course, if you ever want to get lots of people riled up, just say that Dave Ramsey did something bad, and you will get the Dave Ramsey fans come out with their claws out, right? And this one was no exception. Now, I used this to hook people a little bit to get them to read more, where I said, Dave Ramsey cost me my house. And of course, everybody came out. They said, oh, it's because you and your boats and your planes and all that kind of stuff, right? And this and that. And of course, I started to try to create more context, because these people don't even know who they're talking to. They're making just as much crazy judgments about me as every other person on the street. Hey, we've had enough of people blasting people on social media with, with sound bites they think they've heard that they thought they had the right context and they didn't. So anyways, my whole point was that I was trying to build up equity in house, and that's what cost me. I wasn't liquid with cash. And so I get a lot of these people, several of these people on there saying, well, that's why I'm going to save up and pay cash for a house. Because here's the thing with Dave Ramsey is that he'll often say for your own house, you might get a mortgage, but pay it off quickly. But unfortunately, what a lot of people are doing, because they take his advice, even when it comes to rental properties or anything else, they say, no, you shouldn't do that. You should actually save up cash for a house. Because even when it comes to rental properties, he says the same thing. Pay cash only. Do not get a mortgage. Do not go into debt for the house. So I want to actually, and honestly, I came with an open mind. I said, you know what, maybe I'm wrong. Maybe it's possible these people are right. Maybe it is better to save up for a house. Maybe I don't think it's as advantageous. And so I decided to run the numbers, and I want to show you guys what I discovered. In fact, it's actually more shocking than I realized it was. All right, now I wanted to share this one because this is actually one of the comments that was on my post here. And this woman I really felt for. That's why I have the big wow emoji right there, right? Because she says that she works 2 full-time jobs, 80 plus hours a week, pushing to pay cash for a house. Do you think she's the only person in the world that does this? No, of course not. Now, of course, this is highly respectable, incredible that she's doing this. Now, that being said, I came in with this saying, right? I was like, this like chasing a Dalmatian with a fire truck, right? The best thing you do is lock in the real estate price by getting a mortgage and then focus on paying it off with one big check later. That way you use your devalued dollars to pay off the home rather than slave away and chase increasing real estate prices. And you also get to capture the appreciation rather than having to lose your money to appreciation. But you know what? After I said that, I questioned it. And so I want to show you kind of what I discovered here. So the first thing is I think from further down the thread, she was talking about saving a house that was made for like a $200,000 house in today's dollars, right? That's the one big key weakness I see a lot of people have is they keep going for today's dollars. So I said, all right, let's take a $200,000 house. Now, a lot of the homes, especially in this price range, typically appreciate right around 4% a year. Some markets a little bit more, some a little less. And if you're in like bigger cities, it's not as much. But if you're in like suburbs, you tend to see 4.5% is more the typical average. So I put it right at 4. And I said, let's just extend it for 20 years because surely it wouldn't take her 20 years to save up for this thing. So I did that $200,000, appreciating at 4% a year. And this is what you get. Now you'll see year after year, it keeps going and going until it's finally 438,000. So notice that this thing more than doubles the price in 20 years. Really takes about 18 years right there when it doubles in price. Now, she did say she was saving a significant amount of money, and I was impressed. Now, granted, she is working 80 hours a week. It makes sense she has extra. So remember, she's probably paying rent and she's also trying to save up money. So she was saving up about 1,500 a month or 18,000 a year. So I wanted to see, okay, what does that look like? So 18,000. Now I presume that she's going to put it in savings. I'm even going to pretend she's putting it into high yield savings account. Now remember, she's got to pay tax on that. Now, I'll even be nice. I'm going to put it at the 22% tax bracket, even though 80 hours a week probably does push her closer to 24. I'm going to be extra nice here. So boom. All right. So now she's got 462,000. So remember, this is in 20 years, save up 18,000 a year at 3%. She's got more. And that's not bad. In fact, I'm going to change this. I'm going to make it 1,500 just to see if we get a little bit more squeezed out of this sucker, right? 1,500 a month. Okay. She has less. Okay. But that makes sense. If you pay 18,000 month one, that's why. Okay. So she says 457,000. So at what point does she catch up? Well, it looks like it's right about year 19. That's 429. The other one at year 19, 421. So yes, about year 19, she finally has enough cash to buy it. So she has to wait 19 years till it's double the price before she has enough money. Now she's thinking, well, at the rate I'm saving pretty aggressively right now. I'll be there soon, right? And she's like debt free. She's on it. Credit cards paid off and everything. And that was her thing. She's like, I paid off credit cards. I'm like, now I'm putting all of that money towards saving for a house. Again, that's admirable. I mean, that's like super saver status, right? Even with what she's able to do. And I know there's some of you guys that save a lot more than this per year, and it's different, and you could do it faster. But for her, this is a big sacrifice. And just imagine if this were you, if you're trying to put every extra dollar you could just so that it could take you 19 years to finally buy that same house. Now, you might have to keep lowering your standards to buy a cheaper and cheaper home, but what if that is the cheaper home right now? 200,000 doesn't buy much in most areas. It does buy something, but I know here in Utah, 200,000 buys nothing. I mean, a very poor, and not even a good condo right now. I mean, even condos here in Utah go for 300,000. Granted, I'm in the sixth most expensive state now, thanks to the whole post 2020 California wave movement. It's driven up prices here in the West a lot more. So I know out East, you guys could have lower prices. But still, most medium home prices are right around at least 260,000 and above. So again, I'm going with a cheaper home that she's trying to save for. And I think she had even said it was around that price. So just imagine that would take her 18 and a half, 19 years to get there. Now, what if she did like what we're talking about here? What if she did actually go put a small down payment and get a house today, lock in the price? And she'd already been saving, right? So let's just say that again, 5% down payment, $200,000. Now I went shopping online. I found you can get stuff if you have a good credit score, 5.87%. And so I verified it. Now, granted, if you get 5% down, unless you're getting like a second mortgage, you're also getting what's called private mortgage insurance or PMI, right? I put that right down here, $500 a year. I priced it out with one of the lenders. They said it was a little bit less than that. So I rounded up. I also got insurance quotes for the homeowner insurance on that kind of property. It's roughly about $1,400. Of course, it depends on the state. I get that. Property taxes, I based this on property taxes here in Utah, but they were $900 a year for the 200,000 property. So, I mean, that's a decent amount. So anyways, all in all, everything said and done, her payment came out to be after everything here. Whoops, let me take out this part here. Well, I'll take out that part, but it ended up being about $1,123 a month plus the property mortgage insurance. It was like over $1,300 a month, about $1,356 a month is what it came to be. Now, now at first when I ran the numbers, I threw the extra $143 a month, and I was like, oh, well, actually, she'd be better paying cash. But I forgot something. I forgot that, yes, she's still paying rent right now. So I didn't know her rent payment currently. I was pretending it was at 1,200 a month. I figured based on what she's trying to do, that's probably relatively fair, even for a lot of you. Could be more or less. It doesn't take much. So I threw that 1,200 on top of the 143 a month payment. You'll see that extra payment's 1,343. Because again, if she's going to do this kind of thing, and now I told her, and maybe I'll show this separately, but I told her don't pay the extra payment. Save it outside of it, but just pay your payment and then do it this way. But let's just say that she does apply this back because not everybody knows how to invest it. So I'm just going to take it from her perspective. If she takes that extra 1,343 a month, that's the 1,500 plus the 1,200 rent, that's 2,700, right? So the 1,500 she was saving plus 1,200 rent is exactly what she's been saving. She can now put 2,700 a month on this mortgage. Well, guess what? That pays it off in 8 years and 1 month. 8 years and a month, guys. So 8 years she pays off. Remember, she was trying to save up in cash for 19 years. This literally just saved her over 10 years of her life by just buying the house, right? Because remember, you're paying principal and interest, and even the interest total. Let's see, what was the interest total that she paid? Total interest, $49,000 because of all those extra payments she was making. $49,000. But remember, the price more than doubled by the time she saved enough. So unless she's saving like $50,000 a year, which isn't happening, right? And even then she still has to chase it. Unless you're saving $50,000 a year, it's going to be really hard to chase after a $200,000 mortgage or a $200,000 house. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. This is why it's better. And again, that PMI, I also show it not dropping off. It just paying it till the end until it's paid off. Of course, there's a lot of times you can drop off that extra $500 a year and apply that to principal when you get below the 80% mark. I didn't even factor that in because the fact that is she paid it off so quickly, point made, right? That's the big difference. Now, let's just see if we do actually, what if we actually just save this separate? What if we just did the minimum payment here, right? So I'm going to take away this extra payment down to 0. Now we're at the $1,356. Now, what if she did save that extra $1,343 a month elsewhere? Could we do better? I don't know. Let's see. All right. So I want to see kind of like how this breaks down. I'm paying just the minimum monthly payments on this. Now that extra payment we could have put on, the extra 1,300 and change, I'm going to put that in a separate account earning 9%, right? But let's just look at this. Remember, 8 years in, just remember it took 8 years, 1 month to pay it off if you paid extra to the payment. Well, at 8 years and 1 month, it'd be about 165,000 balance. Well, what would that money have been after 8 years and that same, putting that extra money away, the extra 1,300 a month away? Well, here it is, extra 186,000, again, earning 9%. I ran at 8%. It was like still just under 180,000. It was like 179 or 178,000. Still more where it was at year 8. That means between year 7 and 8, you'd have enough cash to pay off your house. So again, if you can earn more interest than what you're accumulating, right? If you earn more interest, yes, that can be done. So that's a big thing. Okay, so long story short, what it means here is that if you invest it, especially if you're earning a higher interest rate, yes, you can actually have more than enough cash to pay off faster. Now, I will say, here's the one big benefit. Even if they were equal, right? Let's just say because they're not that far different. I mean, it's within a year time frame, but the big difference is this. And I'm going to kind of go off the share screen here. So back to me. There we go. Here's the big difference is that when it comes to real life, right? Because we're playing with calculators here, but when it comes to real life, there's a big difference between having the cash on hand versus having the cash inside the equity of your property. Now, everybody's all so hyper-focused on trying to pay down that mortgage and save on interest. Yet, when they need the money the most, especially they put every dollar in there, the problem is that now that money's stuck, the equity's stuck. So of course, I'm typically not going to recommend people just try to pay extra to the mortgage. They could do that. And yes, as you saw in her situation, because of how much she was saving, her not renting anymore, locking a mortgage right now would be able to save her at least 10 or 11 years compared to trying to save it up on her own, depending on how fast appreciation is. If appreciation goes bigger, it's going to take her longer. If it's less, then she might be able to catch up less. But regardless, I mean, there would have to be very, very little appreciation at all for the next 10, 15 years for this to make up for it. This is why I keep saying lock in that mortgage rate. Like lock it in now. You can always refinance to a lower rate later if things don't become that good. And by the way, if you see prices not climbing as much, it's probably for that very reason. So that's the big difference is that save it for cash. Now, if I were to have that again, the third option, which is not just lock in the mortgage now, buy the house now, lock in the price now, so then it can't go up on you anymore. And then you can focus on paying down the mortgage. Instead, pay down the mortgage regularly, use that extra money you would have saved, invest it, create more passive income now. Even if you just save it in the savings, it'll put you in a better situation because now the equity is in your control versus in the bank's control when you try to pay down your mortgage. Until you pay it off, you're not free, right? So that's the big thing. And so if you have that money outside of it, now you have more options because you have that cash to do something with it in case the worst things were to happen in your life. That's, in my opinion, the best scenario. Of course, if you create passive income from it, great. But even if you didn't, just be able to save that money, make a good return on it, having that equity outside could be a benefit. Either way, I've just proven it by the numbers. Locking your price is a good thing. Again, I would never say it's a one size fits all, but you can already see that's the big difference. So all of you that have been debating, hey, should I just save and save for this property? This is true even with investment properties. Why? Why save and save and save to pay cash only when you can get benefit? And I didn't even mention, by the way, that there's interest that gets to be written off on your taxes. I didn't even mention that either, right? The mortgage interest that you write off. And that could also be an expense, even when you're doing rental real estate. The difference is with rental real estate, though, you're getting paid now, right now. You're making cash flow now, and you've locked in the price too. So it's actually a double benefit versus when they tell you just to buy for your own home. If you were to pay cash for anything, save for anything, it'd be your own house because it doesn't pay you anything. But even then, like we already shown, it's better just to lock in the price, not chasing after inflation. Don't chase after those inflating prices. Lock it in and then let inflation be your friend so you gain more equity in the property because that property still becomes worth what it's going to be worth down the road regardless. That's the wiser move. So anyways, I know that's something to be debated. I would love to hear your thoughts in the comments. What do you think? Do you think it is better to save up cash and just buy a house outright in cash? Or do you think it's better to lock in the mortgage and pay it off on your own terms? You decide. You let me know in the comments what you think. If you ever have any questions, reach out to us at moneyripples.com. Make it a wonderful, prosperous week.